Guys, welcome.
Thank you.
Thank you for having us.
Moxon Capital's first ever podcast, so I'm pretty excited to have you.
Oh, wow,
Yeah.
there's a lot of pressure on us as too.
The fact is making some time. I thought we'd start with you guys, just maybe give us a quick elevator pitch of who you are and how we got here. Do you want to go first, Cyril?
Sure. No, thank you. So my name's Cyril Pham. I'm a portfolio manager and principal at Harbour Credit Partners. Harbour Credit Partners is an asset management firm that focuses on providing wholesale liquidity solutions to loan managers, other private credit managers, and specialty finance companies. Probably a really simple term is lending to lenders, if you want to think of it that way, although it encompasses probably a lot more than that. So kind of four primary solutions we provide. We provide primary liquidity, where we underwrite whole loan positions on a loan-by-loan basis for a manager. We can provide secondary liquidity, where we acquire existing positions or loans, so that they can originate, provide liquidity to originate new loans or to satisfy investor redemption requests. Third is, I call fund finance. Could be a warehouse finance facility, and we can get into that a little bit later, or term debt facility, a forward flow arrangement. And then I guess the fourth one is co-investments, where, for particularly large transactions for, private credit managers, which are well established and have good track records, whom we know, we will act as an additive limited partner in those transactions.
And you're a dad.
Yes, I am a dad. Two boys, but one just turned 4, the other 2.
Damian?
I'm Damian Speziali. I run Aurinko Capital, where I do debt advisory. And again, similar to what Cyril mentioned there, a lot of my clients are lenders. So a lot of what I'm doing is helping raise non-bank capital for non-bank lenders. I also look at some M&A opportunities, albeit I'm just finding that with the growth in non-bank lending, that's become a greater and greater part of what I'm doing. And typical clients are looking, it's pre-warehouse, it's looking for 5 to 25 million of growth capital to grow their lending book, and then, can move past that. In addition to that, I've raised my own capital. So I've got a separate business which I manage for investors called Merlot Finance, which provides interim capital solutions. And in that business, I look at both tangible and intangible assets. So can be second mortgages, but can be sports cars or planes or helicopters, but it can also be, an interim solution against a loan portfolio, while I'm then raising third-party capital to assist the lender with those growth opportunities that are there, while we run a process and raise a more substantial piece of capital.
Nice one. And on the family front?
One daughter, 12, going into high school next year. So fingers crossed.
Nice. With a 13 and a 17-year-old, I wish you best of luck. So, it is pretty good. So what the hell is this private credit stuff? Maybe Damien.
Damien, mate, what you have got?
Everyone talks about it. Everyone's got a different definition. What do you think it is?
The way I see it is it's lending by non-banks, and those non-banks lending to corporate borrowers. So there are, I guess, non-bank lenders that also do personal loans. But the way I look at it in this space, it's non-banks lending to borrowers, and they can be SME borrowers, they can be other non-bank financiers, they can be large corporates. So there's a whole gambit is the way I sort of see that private credit market.
Cool.
Yeah, I think Damien puts it well. I think it's become synonymous or equivalent to what they consider to be non-bank lending. I mean, interestingly though, I guess I look at it a little bit more holistically, and why I think actually private credit as a concept is actually probably more well known to people than they probably realize. So for instance, if you think of, private equity, I mean, what is private equity? It's essentially an investment into a private company, or an equity investment or security that's illiquid, not readily tradable or exchangeable. A public equity, obviously, is a listed equity. There's an exchange, there's a deep secondary market typically, which allows that equity security to be sold or bought readily. So I think of it, what is therefore private credit? I guess in some ways, if you share the same analogy, it's essentially a credit instrument that is essentially illiquid in nature, right? So I guess if you take that definition, arguably actually the banks are probably the greatest purveyors of private credit, because ultimately they provide the most credit in a bilateral illiquid form to companies. But look, I think having said that, as Damian correctly identified, people, however, culturally and conceptually think of it as essentially a non-bank institutional providing credit.
Yep.
So,
And how do you see that market in Australia? Where do you think, in terms of globally, we're positioned at the moment? Are we mature, immature, right at the start, right at the end?
Yeah, look, the non-bank portion of that sort of that component of lending has been growing faster than the bank market. I expect that to continue, and more borrowers to look for avenues of non-dilutive capital which sit outside the banking system. So I'd say it's still immature, even though there's been, I guess, private credit. If you think about probably groups like ScotPac and others, they've existed since the late 80s and 90s. There's been non-bank lenders doing invoice finance or asset finance for a long period of time. It's just that, that probably there's more niche and specialty lenders that have come into existence, and also more lenders sort of competing down the risk curve near banks, providing near bank credit, and then people at the other end of the spectrum providing far higher risk VC style funding, whether it's revenue based funding. So there's just become a breadth. So I'd say the market is maturing, but I'd say there's still room for growth, both up and down the risk curve and into new, I guess, asset subclasses via specialty lenders.
I think that's a good summation. It's certainly maturing. It's funny, Damian mentioned ScotPac. I mean, I guess at one of the firms I previously worked at, we actually owned ScotPac as a private equity investment. And interestingly, back then it was considered a very boring company. I mean, my wife is, remarking and wondering why I'm even on a podcast today. She, instead she's, well, you've been doing this thing forever. Why is this suddenly, glamorous in some ways, right? But Damian's right. I guess, and Damian, I guess, probably laughs at this because he's been doing this well before this became very trendy, right? But Damian's right. I think in Australia, unlike the US and Europe, you're starting to see the emergence of these other debt classes and investment classes, which are probably more familiar in those markets, but have never really emerged here in Australia and are now starting to emerge. And it's a function probably of, I think we've all heard the story about regulation of banks becoming more acute, specifically post the global financial crisis, where, because banks essentially borrow short but lend long, right? And when they borrow short, they still have an interest-bearing coupon liability, right, or cash liability, which they have to pay. Which means, therefore, there's a greater focus now on income on the loans that they lend long. And so that's left a real big gap, I guess, in the market, because there are actually, ironically, quite a lot of asset-rich borrowers in Australia, both corporates and individuals, but their income and earnings have not matched the pace of the growth of those asset values. So,
and you talk about it being a complex market. There's many things to navigate there. Maybe on the home front, Cyril, as a dad, what have you learned off your little guys that helps you navigate that market?
Well, I think having children, especially toddlers and babies, kind of allows you to develop a pretty high tolerance for ambiguity and also lack of feedback, constant feedback. Because the reality is a baby and toddler can't communicate with you all that well. So it's pretty difficult to understand what they want, right? And so you therefore develop a really high tolerance for both ambiguity, but also a real degree of information asymmetry, which I guess in private markets is the key characteristic, unlike public markets where signals are provided constantly through constant trading. And then how do you deal with it? But in some ways, therein lies the advantage, because I guess in private markets, that ambiguity and information symmetry, because a lot of people really don't know what's going on. If you can discern what is going on somehow, therein lies the trick and where you can potentially harvest alpha.
Damian, your daughter's a little bit older. Is there more different things you've learned from older kids?
I just think being a parent's, I guess, helped me to mature, and maybe that helps you in, I guess, you're forced to grow up, and maybe that just helps in your understanding and or coping with risk and coping with stress, I think. So I'd say it's assisted me with EQ, which I hope feels made me a better person and therefore a better lender.
Yeah, that's awesome. Cyril, probably one starting with you a little bit because our toddlers was a fair while ago. Toddler tantrums versus market volatility. What's harder to manage?
No doubt toddler tantrums. They're definitely a lot more in your face, physically present and loud. I guess, and also, the reality is it's stemming from someone whom you love unconditionally. So you're bound to be more emotionally invested and more emotionally upset around it. Market volatility, I guess it's something, we embrace in some ways in our role. So I've become quite accustomed to it and quite enjoy it because I guess, where I previously worked at, private equity or even in private credit, the firm we do today, I mean, often volatility creates opportunities,
Yep.
right? So, in some ways that's why we embrace it. And then, I mean, I think I've heard probably enough podcasts and read enough material that even in listed markets, in the face of volatility, the best thing to do is nothing.
Yep.
Right. And often it's really the phrase time in the market rather than timing the market is really the key to wealth creation. So actually volatility, I think, is a good thing from a professional context, but and so therefore toddler tantrums, I'll fob off any day.
I'll say, fortunately, the toddler tantrums are a long way in the past, but I've had borrowers where they're under stress or not getting what they want, where I think sometimes their tantrums can be worse. Sponsors' tantrums can be worse than the toddler's tantrums.
I totally agree with that.
Yeah.
Having sat on the other side in insolvency, I think I've seen a few good ones of those over the years. So everyone, I think, agrees it's a growing class. You guys have already talked about that. When your kids are 20, what do you think this market's going to look like 10, 15, 20 years from now? It's hard to look into the crystal ball, but you got some thoughts, Dan?
Well, I see it becoming, I guess, if you think about that, what we've tried to describe as that market segment of lending to corporate or SME borrowers, I see it being a larger part of a larger share of the market. Continuing to outpace bank growth in lending, but I still assume that bank lending will continue to grow because the banks have access to the cheapest costs of funds. So if they want to do deals, if a bank wants to do a deal, the bank will do the cheapest deal.
Yeah.
But I guess then I see more maturity, whether that's more niche products or just larger non-bank lenders who maybe come down the risk curve. Non-banks are already providing A notes in warehouses and already in syndicates with banks, whether that's on a pari passu basis or providing the term debt behind a bank. So I see probably more collaboration between banks and non-banks. And then also non-banks want a good banking market because some of the deals are a short-term deal while a business matures or beds down an acquisition to then go back to a bank or to go to a bank for the first time. So, I guess the banks and non-banks will continue to work together, potentially being frenemies at times, friends and enemies. I think
I want to ask you about that if I can.
Maybe we'll go to Cyril. Any other comments?
Yeah, I think that's a pretty accurate summation. I think unlike the American Europe, where there's much more fragmentation in the banking system there, and so therefore private credit or fund managers or non-bank financial institutions therefore form a larger part of the ecosystem by virtue of that fragmentation, and also the customization of those markets to much more diverse sources of debt capital markets such as high yield bonds and leveraged loan markets, which are much more liquid as well. So there's the formation and a customization of an investor base there accustomed to these types of instruments. The reality is here in Australia, the banking system is much more concentrated. It's much more powerful, due to the support of, the 4 pillars legislation of the country. So I do agree with Damian that as a consequence that the banks will still always form a very relevant part of the ecosystem. But at the same time, they are still constrained by regulation. So, Damian's right. You're going to start to see more bespoke asset-backed lending, to specific assets which banks aren't really that familiar with as well. And, I think that concept of, lending to lenders, the area which, Damian, traverses in, I think will become much more prevalent because the banks will also want to participate in those structures, but they'll want through exposure through, providing essentially a loan to a pool of those structures, as opposed to lending to them themselves. So.
And where do you think we think globally with that? Do you think it's just something that the big 4 banks here are going to look at? Can you see some of the banks that have pulled out of Australia maybe coming back?
Yeah, another comment there, I guess, when we were talking about that private versus public, we don't have a large
Correct.
bond market here in Australia, so maybe that creates more opportunities for private lenders. But whether it's foreign banks coming back in or large global fixed income managers, or more groups who were previously providing private credit, like, or PEP also providing private lending, so you're just seeing I guess these larger global players or Australian and global players also providing credit, whether it's, PEP or KKR or Bain. So whether it's banks or other large global asset managers doing more in Australia, I think we've got a favourable regime for lenders, good lender favourable bankruptcy laws, regulation and legislation. So I think that will lead to global capital flows to Australia.
Yeah, these also function as superannuation system as well, right? So, Australia, it's interesting, right? I mean, we really punch above our weight in terms of capital flow inflows because, we're still a reasonably small population compared to the developed world, but you essentially have every global financial institution of significance now participating in our markets. Which in some ways is still very real estate centric, to be honest. Let's be completely honest, given Australia is so real estate focused, and there's obviously a real need to develop more real estate. I think everyone's, very cognizant of the housing supply crisis and other key forms of real estate infrastructure that's required. So by virtue of that underlying demand for that type of product, the private credit ecosystem will still very much be real estate centric, no doubt. But at the same time, because of that, the banks focusing on that, their efforts on that as well, means that there's a whole subset of opportunities, small business and middle market corporates, which will be left stranded by those kind of more traditional sources as well. So
you guys do chat to a lot of people inside the industry, people wanting to borrow money. What surprises you that people still misunderstand about private credit? Is there a couple of, maybe Cyril, a couple of key themes?
Well, the definition, as I mentioned, as I said, I think people fail to recognize they're probably a lot more familiar with it. It's not as mysterious as a concept. It's actually been here since the beginning of time. But I guess the other thing is that it's not particularly new, as I said. And then third, the perceived cost of it as well. I think by virtue of the fact Australia, as I mentioned, has a pretty undeveloped fixed income market. Again, function of the oligopoly that the big four, big five banks enjoy. So they've kind of constrained the development of, other debt products, which means that people think all debt is priced the same, right? Like, but, I think Damian correctly put it, the reason why banks are able to offer the cheapest cost of capital is because they're regulated, right? They have the availability of term deposits. They have, even our everyday transaction account, they can use funds from there and there's zero interest paid on those, right? So they can access, wholesale bond markets and have those rated, with the benefit of a government guarantee, right? So it's ultimately a regulated cost of capital. And so it's an artificial cost of capital. It's not true a reflection of the underlying risk profile of the loans being undertaken. Whereas if you look at a fund manager, they raise funds from third-party investors such as high net worth investors, family offices, superannuation funds. And so those types of investors, because that fund manager is not regulated, it does not have the benefit of, say, a government guarantee, they require a high rate of return. And so it's ultimately a function of what their wholesale cost of capital or what the target return they have to offer their investors. And I think that's a failure that's why people fail to distinguish between the two. They just say, well, a bank would have offered me this at 5%. So why aren't you offering to me this at 5%? Right. So, and I think that's probably a key distinction. I
guess that pricing mismatch that a sponsor is looking for non-dilutive capital and they don't realize that, while a bank might price it at 5%, and the private credit firm is suggesting they want 12%, they're not seeing the benefit of the non-dilutive capital the private credit firm is providing, which means that they don't have to go and raise equity for third parties and they can retain all the enterprise value. I guess, and then sometimes they don't see the long picture that private credit might be helping them get from point A to point B, and point B might be a business sale or an IPO or going back to a bank and that cheaper capital once they've bedded down that acquisition or once they've purchase that new machinery. So not understanding the bigger picture and the benefit that private credit can provide in terms of that enterprise value of their business.
Yeah. I think it's because, again, it's a function of the fact that corporate Australia has typically had very simple capital structures.
Yep.
Because there hasn't been the development of a bond market or high yield market or liquid leverage loan market in Australia. So, they're accustomed to only bank debt and nothing else. So when they see a double-digit rate of return, the alarm bells just start ringing, right? And they think it's some kind of vulture capital or vulture credit, predatory credit. But actually, it's probably a better, true, as I say, underlying reflection of the risk, the return that is required for that degree of risk. Because, and maybe there's this another kind of misconception that somehow credit in some way as an investment class is much easier to execute and manage and assess than, say, equity. Because it's been, you see a low cost of capital like 5%, it must be easy to do. It must be simple, right? Whereas a private equity investor commanding 20%, that's hard, that's complicated. But if anything, actually, the questions you ask of a company are exactly the same, whether you're a debt investor or an equity investor, right? You ultimately want to determine, is it a good company? Is it a good business? Does it have a sound management team? Is it operating in an industry with macro tailwinds? And then ultimately you determine, based on the risk I want to take, which part of the capital structure you wish to invest in. But debt lending is not seen as investing in Australia, where it very much is ultimately a form of investment. And as a consequence, people don't regard it that way. They see it as a commoditized form of capital, right? And should be priced in that way. Right.
To flip it around the other way, do you see anything you incurred day-to-day at work, these private credit deals influencing the way you parent?
Well, I mean,
maybe around the risk of being a parent, managing that against
it's interesting, right? Like, I guess with a 4 and 2-year-old, it's very difficult to control anything they do. So I guess as a credit investor, it kind of, in some ways, I'm always wrestling with that, like that conundrum. I mean, look, I think even though, as I mentioned, credit is an investment, right? So you want to put some controls around things, and but at the same time, you still have to take risk to make return, right? So I mean, I think the idea that credit has no risk is another misconception, that it's riskless, right? So you have to accept that your children, even despite all the controls and and rules you put in front of them, you have to actually allow them to also take risk as well. Right.
And dad teaching a daughter to drive at the moment, I can absolutely agree with that.
Because otherwise, unfortunately, they'll never develop their own skills, their own sense of independence, and even their own risk assessment. But as a father, it's very difficult because, you love them so much that you don't want to put them in harm's way. But ultimately, you have to accept that they have to take some risk as well. So,
yeah, I'd say that, managing money is not life and death. So maybe you can take some more risk when you're investing and managing money. I'm not a brain surgeon, so if I get it wrong, maybe there could be a loss. Not that we ever want to have a loss, but
sure.
We're typically making rich people richer. We're not surgeons. We're not solving larger issues.
Yeah, it's an interesting concept, right? Like why we get up and go to work in the morning, and what we're achieving, and what we think stressful compared to.
That's right.
Someone working in the so
got to keep things in perspective, I think.
Absolutely.
So,
parents do it different ways. Some are quite authoritative. Some give their kids a long lead. How does that translate into what you do in your business?
Well, I think typically, the loan documents are set in favour of a lender. Yep. So I guess that gives you, I guess, a legal basis to manage money in quite an authoritative way, potentially more than you would in your parenting. There's a set of rules, there's a set of financial undertakings. Are they being complied with? And if not, is there a consequence? And is I guess you're more in the lead position to manage those issues. Maybe that makes it more black and white than parenting, which is far more nuanced.
Yeah. You have to learn to be empathetic as well, because ultimately you are even though you're dealing with a company or a business, there are people running that company. There are people which are shareholders and stakeholders in that company. And so ultimately learning emotional intelligence and empathy for their situation is also important. So, despite, you do have a loan and security document, which is black and white in terms of your legal rights, but at the same time, you have to be equitable to them as well, because at the same time, you want to make sure that there's a good working functional relationship, because no matter all the loan and security documents in the world, if the relationship breaks down, there'll be a contest over those loan and security documents, which you definitely do not want to occur.
What on the horizon? There's been some white papers in Australia. What are you feeling at a high level might be coming for us?
There's been talk of more regulation and maybe trying to align the interest of the manager and the investor more, such that there's not large fees which are going to the manager versus a lower return to the investors. So I see a level of regulation, or a level of hopefully just additional disclosure, as a way of ensuring that maybe players who are acting in a way that's not in the best interest of their investors, I guess, are found out, and that portion of the market, which I think would only be a small subset of the market, does not grow. So I think I don't know if it's self-regulation in the form of enhanced reporting, but I think that there could be, I definitely think there could be benefit to ensure that the best managers are receiving greater capital inflows than lesser players.
Cyril?
Yeah, I think it's, as I said, and it's probably a function, as I mentioned, because of the lack of maturity development of Australia's debt capital markets. There's probably an underappreciation of the risks of credit investments.
Yep.
As I said, because it's been often attributed to the banks, it's considered safe and simple.
Yeah.
So what I'm investing in must be very safe and simple. But obviously, there have been a number of case studies very recently, and which have been widely reported, which have not been the case, to a lot of investors' surprise, right? And for instance, and I often rabbit on about this to people, but the term first mortgage, and loan to value ratio, so often you see advertisements saying first mortgage 50% LVR. Well, against what, right? What's the first mortgage against? But the first mortgage creates this real sense of security.
Yep.
It's safe. It's secured. I'm first in line. And there's a 50% LVR, so it has to decline by 50% before I lose money, right? And so there's a sense that any asset can be sold readily without any modification and quickly. There's actually very few assets which can be sold very quickly and without modification, maybe unlike a completed residential property, right? But say a construction site, a company, if a company's earnings goes down, you can't just readily sell it in its form, right? It has, you were insolvency, you have to restructure, you need to turn around to get the earnings back to a stable footing. A half-built construction site, no one's going to buy that. Someone's got to step in and build it, but easier said than done. I did extension to my house, and something as simple as that, the layer of complication and unknown risks, around that, befuddles the mind. So I think this thing about, increased transparency regulation is good, in the sense that it's to educate investors what is the actual risk profile of the investment they're making.
Yep.
And, if they do have a proper appreciation, they can do whatever they want.
Yep.
It's a free country.
Yep.
As long as you properly understand the risk.
Yep.
If you want to take that risk, then great, right? But the problem is, I think at the moment, there's probably a lack of transparent understanding as to the true risk profile of the investments which they're undertaking, which I think is only a good thing, that therefore that education and process by the regulators continues.
Deals. We all work on lots of deals. We've all spent way too many years working on deals. The phone's constantly ringing. You and I have got smaller businesses. We both rely on our partners pretty heavily around those businesses. Cyril, you've got a bigger team with its own nuances. Deals never sleep, but how do you balance that with kids, family, holidays, or you just don't? What's the truth?
Yeah, sometimes it's really difficult, and you're very reliant on the goodwill of your partner in helping when things are going crazy, and I think I really try to be cognizant of not taking on too much work now, to ensure that I'm not a bad dad, that I can be present at times, but it's a challenge, and it's something that at times is in the back of my mind.
Do you think you ever get it right, or it's a constant balance?
A constant balance, and I guess there's there are times where there's that concern that I'm doing too much work and I'm not present.
Yep.
Yeah, I'm probably showing my age. There used to be this cartoon called Alex,
Yep.
about, the investment bank always on his phone, his wife getting onto him. So I promised myself I would never become that guy, but my wife always constantly says, "You're not listening, you're not being present, you're staring off into the sunset."
Yep.
Right. Often my mind is elsewhere.
Mate, it's not just you. I was taking my daughter to tennis this morning, think about a deal, and I drove her to
Yeah.
school. So
And
it's definitely
so,
not just
look, you're right. I mean, unfortunately, I do have a team, but I think because, we're all kind of been involved in this, this type of space for so long, it's very difficult to disentangle yourself from the actual deal itself.
Yep.
And so, yeah, it's a constant struggle. I'm very fortunate that my wife, is extremely tolerant and supportive of our children because, to be honest, I'd rather be me than her managing two boys at home by herself. It's physically exhausting. So I recognize how difficult it is for her. And if it were not for her, it'd be very difficult to do what I do. Thankfully, though, I guess, I do try to structure my days, in the morning where I do take my children to daycare every morning. I try to be home before bedtime to put them to bed. I do keep my weekends free as much as humanly possible, so I can take my son to swimming and soccer. And my sons have had some health issues as well, so I mean that's been a little bit confronting. But so obviously I've prioritized that to make sure. But again, team's been very supportive. My partners have been very supportive of that because they have families themselves. I think also showing that flexibility to our employees and staff. Recognizing that if you can allow them to spend some time with their families and not feel too stressed about it, they'll feel better at work anyway and be more productive
Yeah,
too.
absolutely.
So
We've all worked in big shops with some required FaceTime, some hidden in terms of presence in the office. Now, more doing our own things is maybe one way to put it. What's the market going to look like? You've got a great shop, you've got some excellent clients. What do you think that market's going to continue to do over the next few years? How are the big banks going to compete with you? Because I think some ways they're now looking at people like you as a competitor.
Oh, I won't go that far. But look, I think if I can facilitate more high quality borrowers growing and achieving their goals in a way that's non-dilutive, so that they don't have to give up equity and they can become wealthier and meet their aspirations, meet their goals, grow their businesses, hire more staff, grow the economy. That's it's you can sort of create these win-wins where you get this repeat business. You've got these clients that grow, you grow with them, and hopefully I can develop those relationships and be referred more high quality clients to then go and grow new relationships as well. And maybe at one point be selective in terms of the clients that I take on rather than
The Nirvana.
the Nirvana rather than having to take on, every bit of work and scrap. But look, I think obviously the sort of because of this growth in this non-bank lending, it's provided an opportunity for me to move into my own business and grow with some of these clients and help them grow their businesses and access capital. So I hope that continues.
Cyril, but yours is a bit of a different story. You've come out of a big shop. You then had your own business. Not so long ago, you merged in with another group that was actually a customer at one stage, I think, for a while.
Well, yeah.
How have you
They
found,
still are, I guess.
Still are, I guess.
Yeah.
How you found that dynamic? How's that changed?
Yeah,
How do you balanced it?
You're right. We have operated quite small and independently for a long time, but then a limited partner of ours who had been a big supporter of our fund previously then suggested that they vend in their private credit portfolio and division into ours and merge the two and then become shareholders in the platform of the business. And that's actually been quite fruitful, actually. I mean, to be fair though, we'd known them for such a long time. We had dated for such a long time before we got married. So in some ways, the dating process was quite extensive. So we kind of knew already what we were getting into. But, they've been great partners, friends as well, really friends for first and foremost, but great partners. And, I think you recognize also you learn a lot from others as well. I would think that I have some experience and perspective, but you're never going to have the experience and perspective completely of what others know, right? And having more perspective, having more input, collaboration, and differing points of view actually is important, right? But at the same time, there has to be a healthy emotional friendship as well to tolerate the discourse. But it's been great, and it's allowed us to grow a lot faster than expected. We've been lucky as well. I mean, I think we often recognize luck plays a big part in the conditions of your business, and market conditions have been good for what we do. I think when Damian said, I think we're not really competitors to the banks in some ways, because the banks aren't going to do what we do anyway, right? But
Do you think they'll need to, if they want to continue to get the return?
no, I
Do you
don't think
think
no, because you see, I think there's a big enough ecosystem doing what they already do. And two, there's a lot of people out there which need home loans. Still, and it's a growing market. It will continue to be a growing market. It's a huge market, and there's actually still quite a lot of bankable corporates, which are pretty lowly geared, asset rich, cash flow rich, which suit them quite well.
Yep.
Right.
There's also that opportunity where if a business that is a bank client is underperforming
Yep.
and
Correct.
needs to
Yep,
leave
that's
the
right.
bank
That's a good
for a
question.
period of
Yeah,
time
exactly.
for restructuring, or to sell some assets, or maybe the sponsors need to sell some assets to put more equity and inject it into the business. So again, it's that there's a collaboration there. There's growing clients to get to the stage where they're a bank client, or
Correct.
those clients that are underperforming, those borrowers that are underperforming, leaving the bank and going to private credit. that is also part of that ecosystem that exists.
It's a very good point. Yeah. It's a very good point.
We're all pretty lucky. We've had good runs, good careers, got good houses to live in. We've been looked after. How do you teach your kids about money in that environment? The kids, have got most of what they will ever need.
Right.
How do you still teach them responsibility around money?
I think just firstly being considerate of others is one thing, because I think if you're considerate of others, you value others. You therefore value what they have or what they've earned. And being respectful of others is a good starting point. But I guess other things, like I think just actually giving them, maybe seeding an ETF or some kind of account for them to watch it themselves, because I think the best way to learn about money and managing it is actually having it, and actually managing some form of investment.
Yeah, I don't think financial literacy was taught at school when we were at school, and no, I don't. To the best of my knowledge, and look, I don't know what the high school curriculum is like now, 30 years later, but I assume it's still not. It's not taught.
No.
Still not.
So it's still in year 12, and it's not.
So what Cyril is suggesting there is is sensible. Trying to having that savings account where the birthday money from the grandparents go into, and then you can ask to access it if you want certain items, and about to have a teenage daughter, probably making, so there'll be those increasing things about fashion and all these, other things which I don't understand. So, just probably there's that piece about not giving her everything that she wants, managing that so that, the assumption is that I'm not just a credit card.
Yep.
And ensuring that, she's doing those chores, and then when the time is right, getting a part-time job, I guess.
Yeah. I think I remember in high school maths, they did teach about compounding interest.
Yeah.
But it's interesting how everyone just forgets about it, right? But it's a very simple concept.
Couple of things to finish. Everyone's got a great war story. A great war story where you've just in the end had to say no. It's, you don't have to pick every fight that's offered to you. Cyril, same sort of thing. Is there a story there somewhere where you've just had to get to a point where you've said it is best for everyone to say no, even though maybe the borrower is, really putting the pressure on?
Damian mentioned this with Scott-backed business finance. Like, back in the old days at Lazard when we bought it, no one really knew what factoring was, to be honest.
Yep.
It was a non-bank financial institution being sold by Aurinko, which was in receivership, which had the stain of that. No one wanted to lend to it at the time through warehouse finance because it's just post GFC. And then also no one wanted to pay a good price for it. We paid a multiple of earnings versus just book value, but kind of navigating through that, persisting through all those challenges. And I think it's just, demonstrating persistence, because ultimately we did get someone to lend to it, provide a warehouse facility. We did ultimately buy it at, I think, a fair price for a great business. And we bought something that was not well understood, but now is one of the biggest working capital, success stories in Australian history. So I think that's a good war story about trying to persist through a lot of ambiguity, difficulty, and resilience, and ultimately leads to often the best investments.
I think there was one I remember, it was before the COVID lockdown, and it was a business which would have been highly affected by the lockdown in terms of its revenue would have dropped close to nil. And we were trying to negotiate about the sponsors just putting in that little bit extra equity. Maybe it was 5% extra equity, and they wouldn't put it in. And so the deal failed, and we were so lucky that deal failed. It was like dodging bullets in the Matrix, because that would have been a terrible deal if we'd actually settled it. Who would have thought we all would have been locked in our homes, and this discretionary revenue would have just dropped to basically nothing. So that was clearly more luck than skill, but a good one to dodge.
Well, I think it's a timely reminder how much luck plays in these things.
Absolutely.
Right? I mean, you can have the best thesis in the world. And actually, I think it's a timely reminder, all the risk or the probability is in your favor, but sometimes the really improbable thing happens, right? And I think COVID's a good example of that. Actually, a lot of good businesses, worthy businesses, worthy of investment and capital, but then the 100-year event happens and destroys them, right? Now, having said that, does that mean you shouldn't have done in the first place? No, because ultimately, with all the data at that point in time, the balance of probabilities was in your favor. But I think sometimes people often equate the bad outcome with the poor decision, where in fact it was a fine decision, but it's a recognition that luck plays a much bigger part than everyone realizes in life and in investing.
Absolutely.
So,
Who should ring you? Who should come and have a coffee with you? Who do you want to talk to?
Fintechs, small startup lenders, people looking to grow past a limited investor base, and access somewhat institutional capital as they continue to expand on their journey, or businesses looking to acquire other businesses, probably in that $5 to $25 million sweet spot.
Excellent. Cyril?
in some ways, what Damian and I do are quite similar. Probably right now, the thing we're focusing a lot on though is, private credit managers, fund managers, or finance companies doing, very simple, what I call bridge lending, where, they might borrow against their house to buy another business or acquire another business or grow the business or address creditors. Essentially what the old business bank used to do.
Yeah.
Right. He used to trudge down to the CBA branch or the NAB branch. There'd be a very nice gentleman there or lady and said, I want to grow my business. They said, okay, fine, just put your house up as collateral, right? Or your investment property as collateral. Now, for a variety of reasons, as I mentioned, regulation makes that a lot more challenging nowadays. So we're essentially looking for lenders of that ilk, looking for capital, essentially, where we can underwrite whole positions or purchase existing positions from them, or, if they're a little bit more mature and scaled, we can provide a warehouse facility, for instance, with Damian structuring expertise, of course. But we're probably a little bit less punitive than what a traditional securitization provider would provide from, say, a big bank. So that's kind of what we're doing at the moment, primarily. But we have looked at other asset classes. We have looked at invoices. Clearly, we have experience in that. Auto loans, auto lenders, equipment finance lenders, legal disbursements lenders, invoices. But right now, we're just finding there's pretty good opportunity, backing or providing capital to lenders and private managers, loan managers doing real estate bridge lending.
Guys, thanks. It's pretty clear you've both got great businesses. You're obviously good partners and great dads. So great to chat to you today.